Good morning. Thank you for joining today's daily webinar. Today, we're going to talk about the solo 401k advantage, specifically how the pro-rata rule does not apply to the mega backdoor Roth self-directed 401k conversion, which does apply if you do a backdoor Roth IRA conversion. We're also going to answer some of your questions here on the live chat. Don't forget to subscribe to our YouTube channel, like our video for more presentations like this. We're also going to be providing educational material today. We're not going to be providing investment advice or tax advice on today's daily webinar. You can also join us today at 1 p.m. Pacific time for our second daily webinar. We go live twice a day. Once at 10 a.m. Pacific time and a second time at 1 p.m. Pacific time. All right. Before we get started, I see a question here on the live chat, so let's take a look at that. Looks like we have a question from Charles. My wife currently has a solo 401k at Schwab. She wants to do a mega backdoor. What happens to the Schwab account when we open a new account through your program? So we have many clients that fall under this particular scenario where they have a solo 401k at Schwab, and now they want to upgrade to a self-directed 401k from my solo 401k financial because they want to gain more features, including being able to perform the mega backdoor Roth. The process to accomplish that is, first, you need to transfer that existing solo 401k at Schwab to a solo 401k from my solo 401k financial. That's called a restatement. You would first complete our online application under the open account section of our website. Let me send that link over. On that online application where we collect information, some of the information that we're going to collect is information surrounding the existing plan. We're going to ask for the original effective date of that existing Schwab Solo 401k so that we can populate that date on the new self-directed 401k plan establishment documents. So that's the first step, to switch from the plan at Schwab, so from their solo 401k to a self-directed solo 401k from my solo 401k financial. Once you complete that online application, we're going to draft the plan documents same day. We'll provide a download link for your signature. You upload the documents. You then respond to a next steps questionnaire where you let us know that you want to use Schwab for the new brokerage accounts for the self-directed 401k that we offer. We'll then draft those Schwab brokerage accounts. We're going to draft a total of 3 separate brokerage account forms. Let me share my screen to shed more light on that. Regarding the separate brokerage accounts that will need to be drafted. So if just your wife is going to be participating in the plan, it's going to be one plan, but 3 separate brokerage accounts at Schwab. Schwab refers to brokerage accounts for the solo 401k plan that we offer as company retirement account brokerage accounts. So we're going to draft 3 separate company retirement brokerage accounts at Schwab. The first one is to hold the pre-tax solo 401k funds. The second one is to hold the Roth solo 401k funds. And the third and final one is to hold the voluntary after-tax solo 401k funds. So one plan, 3 separate brokerage accounts for each source of funds at Schwab, since it's one participant. So we'll draft these. We can fax them to Schwab for you, or you can upload them to Schwab using your existing login information. Schwab will then open these 3 brokerage accounts for the self-directed 401k plan. Subsequently, we'll prepare an internal transfer form, which will direct Schwab to move over their existing solo 401k plan internally to the new self-directed 401k offered by my solo 401k financial. So most likely that Schwab solo 401k that you have has pre-tax solo 401k funds and might even have some equities. Those funds and the equities would get transferred over internally to the new pre-tax solo 401k brokerage account at Schwab for the self-directed solo 401k that we offer. Then, when you're ready to make the voluntary after-tax solo 401k contribution, you're going to make it directly to the voluntary after-tax brokerage account at Schwab. Let me pull up some information on that. So once you make that contribution to that voluntary after-tax solo 401k brokerage account, then you're going to need to convert those funds over to the Roth solo 401k plan. So they'll go into the voluntary after-tax bucket, then they get converted to the Roth solo 401k bucket. So it's all within the same plan. And here's the procedure to move those funds. You're going to essentially fill out Schwab's internal conversion form so they can move those funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket. Then you need to complete our online conversion form so we collect the necessary information to issue the Form 1099-R to report on non-taxable conversion to the government. Okay. We'll come back and look at some more questions here once we get going here with our daily webinar presentation. Let's see here. Again, so we're going to talk about how the pro-rata rule, which applies to the backdoor Roth IRA conversion, does not apply to the mega backdoor Roth self-directed 401k, aka solo 401k plan. And the reason it doesn't apply to the mega backdoor Roth 401k conversion is because when contributions are made to the solo 401k plan, they have to be made according to each source of funds, and they have to be separately tracked under the plan, and that's done by opening up separate bank accounts or brokerage accounts. If I can share my screen here a little bit better. There it is. So when you make a voluntary after-tax contribution to the solo 401k plan, that needs to be deposited to the separate account that's set up specifically to hold those voluntary after-tax funds. So using the example of, let's say you use Schwab to hold the solo 401k funds for the self-directed 401k. Again, we would help you open up 3 separate brokerage accounts at Schwab. You would make the voluntary after-tax contribution to the voluntary after-tax solo 401k bucket. So as an example, let's say for tax year 2025, your business is taxed as an S corporation. Let's further assume that you pay yourself at least 70,000 of box 1 gross wages in the amount of $70,000. So the W-2 that you receive from your self-employed S corporation reflects $70,000. You would deposit, and then let's further assume you solely want to make voluntary after-tax solo 401k contributions. You would deposit that entire $70,000 to the voluntary after-tax solo 401k bank or brokerage account. So those funds are specifically segregated through that holding account, that voluntary after-tax holding account. You then will convert that to the Roth solo 401k. That's why it's not going to, that's why the pro-rata rule won't come into play, because you then commingle all the funds into one brokerage account. You put them directly into separate holding accounts. In this example, you put the entire $70,000 into the voluntary after-tax bucket. So it's already isolated. And then you convert that over to the Roth solo 401k, or you can convert it to a Roth IRA instead. Now, how is that different from a backdoor Roth IRA conversion? Well, when you do a backdoor Roth IRA conversion, you make a non-deductible IRA contribution, and that's because your income is too high. And let's say you make it for 2025, the IRA contribution limits are $7,000. So let's say you make a $7,000 non-deductible IRA contribution. Let's further assume that you also have other IRAs that have a balance. Well, you're not going to be able to just solely convert the non-deductible IRA funds, because the IRA rules require that you look at all of your IRAs. So yeah, if you have another IRA or a SEP IRA or a simple IRA, and those also have balances, those will impact the amount of non-deductible IRA funds you're going to be able to convert, because you're going to have to convert some from those IRA, some from those pre-tax IRA, some of those pre-tax IRA funds, and then some from the non-deductible IRA. So again, that pro-rata rule doesn't apply to 401ks. So even if you have another 401k, let's say you have a 401k at your daytime job, and then you have a solo 401k, and let's say, going back to my example, you make a $70,000 voluntary after-tax contribution, you're going to be able to convert that entire $70,000 to the Roth solo 401k or a Roth IRA without having to convert any of your daytime employer 401k funds. So that's one of the great advantages of the solo 401k over the Roth IRA, is the fact that the pro-rata rules do not apply to the mega backdoor Roth solo 401k. As a matter of fact, let's see if I can share a page from our website that talks more about the pro-rata rule not applying. We're going to go to our main voluntary after-tax contribution page. Here's a nice Q&A that we have here. Pro-rata rule. Does the pro-rata rule apply to after-tax solo 401k contributions like non-deductible IRA contributions? If the after-tax contributions are separately accounted for, the pro-rata rule only applies to the solo 401k after-tax sub-account. So that goes back to that slide I showed you where you have separate bank or brokerage accounts under the solo 401k to track each contribution source. And if there are no gains in that voluntary after-tax bucket when you make that contribution, then there won't be any taxes due. If there are some earnings, let's say a few dollars, then you'll pay taxes on those earnings when they get converted to the Roth solo 401k or the Roth IRA. Now you can learn more about the pro-rata rule as to how it does not apply to the self-directed 401k by looking at IRS code 72D number 2, which allows for separate accounting. That's our separate accounting we were talking about, how you have separate holding accounts under the plan. And then look at IRS notice 2014-54 that talks about how the pro-rata rule applies at the account level. Again, at the account level, meaning at the separate bank account, brokerage account level. So this level right here, we're talking about the separate, the separate account. So any funds that are inside this voluntary after-tax solo 401k bucket, when you do the conversion, you got to convert everything. So that's why most clients will convert the voluntary after-tax contribution immediately so that there are no gains. but it's not going to impact any of your other buckets or any of your other 401k plans. Okay, let's see here. Let's take a look at some more questions here. Oh, we got a question here from Hua. Can I post my questions here? Yes, you can. I'm here in the live chat. Go ahead and post your questions. Okay, so while we wait for other questions here to be posted, let's talk about the steps required to process the Mega Backdoor Roth Solo 401k conversion. So we just talked about the pro-rata rule. Okay, so obviously before you can perform the Mega Backdoor Roth conversion, you need to qualify for a solo 401k plan. So to qualify, you need to be self-employed, not employ any non-owner full-time W-2 employees who work 1,000 hours or more in any of your self-employed businesses. And then you need to choose a self-directed 401k provider whose plan documents allow for the Mega Backdoor Roth strategy, like a company, my solo 401k financial does allow for it. You then need to open that self-directed 401k. Once you open that self-directed 401k, you then choose where you want to hold those self-directed 401k funds. They can be held over at a brokerage firm such as Schwab or Fidelity or even your local bank. We then help you open up those holding accounts at the Fidelity, Schwab, or your local bank. One of those holding accounts is going to be a designated account titled voluntary after tax. So it's going to be titled voluntary after tax. So that way you then make the contribution, that voluntary after tax contribution to that designated voluntary after tax holding account. Then you're going to convert those voluntary after tax funds to the Roth Solo 401k or the Roth IRA. You're going to want to do that immediately so that there are little gains, because any gains that get converted are going to be taxable. The bases will not. And then you need to complete our online conversion form so we collect the necessary information to issue that Form 1099-R to report that Mega Backdoor Roth conversion to the government. We'll do that by completing the final step, which is step 5, where we'll issue a Form 1099-R with the copy filed with the IRS and a copy sent to you to report it on your Form 1040 personal tax return. So that's how the Mega Backdoor Roth steps work. Now, keep in mind, you still have plenty of time to open up a solo 401k plan for tax year 2024 so that you can do the Mega Backdoor Roth. You have until your business tax return due date plus timely filed extension in 2025 to open a solo 401k for 2024, and you'll be able to make contributions for 2024 here in 2025 by your business tax return due date plus timely filed extension. So that's true for making voluntary after-tax contributions. So for instance, if your self-employed business is a sole proprietorship and you want to open a solo 401k plan here in 2025, so that you can make voluntary after-tax contributions for 2024, you'll be able to do that by April 15, or if you file for an extension by October 15 of 2025. And you'll be able to make contributions for 2024 based on your net self-employment income. So Schedule C, line 31, if your business is taxed as a sole proprietorship. Another example, if your business is taxed as an S corporation, then you have until March 15 or until September 15 of 2025 to open the plan and make voluntary after-tax solo 401k contributions for tax year 2024. So you have plenty of time to still do the Mega Backdoor Roth strategy for 2024 and even for 2025. All right, let's take a look at some more live questions here. Got a question here. I'm closing my existing plan with the small corporation in Maryland, and I moved to a new state this year and opened a new business in Georgia. So try to transfer my 401k account from my existing one to the new one. Should I terminate the old plan and adopt the new 401k account? Great question. You certainly do not want to do that because then you're going to have to wait 12 months before you can open another solo 401k plan. That's known as the cooling off period. So instead, what you want to do is you're going to want to have that plan updated to list the new self-employed business. If you are a client of my solo 401k plan, go ahead and submit a support ticket and we'll shepherd you through that process where we'll need to update the plan to list the new self-employed business. Therefore, you'll be able to keep the same plan name, same EIN number, same holding accounts. We'll just need to update the plan documents to reflect the new self-employed business. I just share that support ticket. That's the way you want to do it. Now, if you're not a client of my solo 401k financial, you want to restate to us, you can also do that. So definitely do not close the plan because then you're going to have to wait 12 months before you can open up another one. That's known as the cooling off period. And that's been put in place by the government, I suspect, to keep individuals from churning their churning solo 401k plans. See if I can find some information on that to share with you. Here we go. It's called a successor plan rule. I like to call it the cooling off period. Let me share that link with you as well. There's the link and here's the page. Got some IRS resources there. So yeah, you do not want to close that plan because then you're going to have to wait 12 months to open up another one. All right. See if we have any other questions here. Here's a good question here from Charles. At some point in the future, we want to unwind the account. What are the options? Roll over to an IRA, roll over to a basic Schwab or Fidelity 401k plan. So different scenarios apply. Let's pull up a good page from our website. Here we go. Here's a good page from our website. And there's a search. You can do a lot of searching on our website through this little box right here. You just need to enter some keywords and hit enter and you'll get a good search result. So let me share this link and we'll go over it as well. Okay. So different scenarios apply. Number one, if you're no longer self-employed, you can close the solo 401k plan and you can transfer it to an IRA. That's one of the options. Or if you work for an employer, a daytime employer, you can transfer it to that daytime employer's 401k. Or if your business grows and you hire W-2 employees that now qualify for a 401k, you're going to have to convert that solo 401k plan to a full-time employer 401k for your business. So your options would be transferred to an IRA. You can convert it to a full-time employer plan, or let's say you want to switch back to a basic solo 401k that doesn't have all the bells and whistles. For example, it doesn't allow for 401k participant loans. It doesn't allow for voluntary after-tax solo 401k contributions. It doesn't allow for employer Roth contributions. It doesn't come with a $1,500 auto contribution credit. Then you could switch to a standard Schwab solo 401k or Fidelity solo 401k plan. You would need to communicate that with us and work with Schwab and moving it over to their Schwab solo 401k. And then we would need to update our records as no longer falling under our plan. So that way we're no longer responsible for your plan. All right, so take a look at this link here. Let me share that link with you here on the website. All right, well, it looks like we've come to the end of our time today. We really appreciate you joining this morning's daily webinar where we discussed the solo 401k advantage, specifically how the pro-rata rule does not apply to the mega backdoor Roth like it does to the backdoor Roth IRA. We also answer your questions here. We'll be back again here at 1 p.m. Pacific time. Until then, have a great rest of the day.